All right, we talked to a lot of lawyers, right? I'm not one myself, but I've watched a lot of legal shows, so I think I qualify America. Anyway, our John Decker, our White House Fox radio correspondent, is a lawyer. He says, that FISA warrants are extremely difficult to obtain. Now, that flies in the face of Judge Napolitano told me that they're almost always obtained, 99.97%. But what do I know? Anyway, he says a very high bar must be cleared before a judge who sits on a FISA court will greenlight a FISA application. Now, what this memo seems to be saying is it was based largely on this Trump dossier compiled by this Christopher Steele, not a fan of Donald Trump, and a dossier largely funded by the Democratic Party. Now, even if that were the case, even those who argue, against the release of all of this say, well, the ends justify the means, because even if this started out to be a shady reason to get into the investigation of then-candidate Trump and his surrogates, look what we've uncovered. We don't know what they've uncovered. What we do know is that it started under a rather nebulous theme, and that is what's causing some sort of cacophony on the Hill here, that it's all politically motivated, that it started for all the wrong reasons, a political axe to grind. You've heard all of that on this broadcast, in fact. But again, it's this back and forth we're going to continue pursuing. Some say that's all a FISA court needs. Others saying it needs a lot more than that. To John's point, I don't know what the truth is. I'm just sharing with you. Some who say that they need a little more than a ham sandwich to go ahead and approve an indictment, and others say that they need a higher bar. So therein lies the rub and the debate. I don't know what the truth is. What I do know is that we're selling off aggressively, and what I do know, it has very little to do with this, because even with the expectation of the release of this memo today, stocks were swooning and started really swooning when we got the jobs report out that showed stronger growth and interest rates backing up to 4-year highs on expectations they could back up even some more with an improving economy. Then lo and behold, this next fellow came out predicting unemployment isn't only going to hold steady, it's going to go a lot lower than the 4.1% we're looking at. Try 3.5% likely by this time next year. Chief economist Mark Zandi on that right now. Mark, good to have you. Thanks for taking the time.
Hi, Neil.
So what do you see? What would bring it down to 3.5%? A continuation of a tightening labor market trend, or what?
Yeah, we just need to maintain job growth for the coming year, similar to the job growth we've been getting over the past 3, 4, 5, 6 years. If we get that, then yeah, 3.5% is likely. I mean, the unemployment rate, Neil, believe it or not, has been falling 0.5 percentage point per annum for the last almost 9 years. So just a continuation of that will get us to 3.5.
All right. Now, everyone suddenly is concerned about wage growth. It picked up at a 2.9% clip in the latest period. Good for those finally enjoying that. I guess bad for those worried about inflation or interest rate hikes or all of the above. Where are you?
Yeah, well, interest rates are headed higher, in large part because that unemployment rate is getting so low, and wage and price pressures are developing and will develop more fully as we make our way through the year into next. And, of course, now we're going to have bigger budget deficits for the tax cuts. Those are deficit financed. So the Treasury is going to issue about $1 trillion worth of Treasury bonds this year compared to about $500 billion last year. So, you add all that up, that means higher interest rates. And, of course, all else being equal, that's not great for stocks.
All right. So you're, Jerome Powell, you're coming in to take over the Federal Reserve. You've kind of mirrored the votes, of Janet Yellen before Ben Bernanke. Are you now just as inclined to speed up the pace of hikes, the kind of thing that Janet Yellen seemed to intimate at the last meeting?
Yeah, I think he's going to have to. The Federal Reserve is going to have to raise rates in a more consistent way. I mean, I think when they gave us their last forecast for short-term interest rates for the coming year next year, they said 3 rate hikes this year, 25 basis points, quarter point each time, and 3 next. I suspect it's going to have to be more than that, 4 rate hikes this year, 4 rate hikes next year. And, of course, investors, markets, they're just now starting to buy into that kind of idea, and that's why I think stock prices are down. I think investors are just adjusting their expectations. They realize that the Fed's going to have to be more aggressive here.
So is this fall off today, it's a pretty severe one, justified?
Yeah, I think, I've been skeptical of this run-up in stock prices. I mean, you got to put it into context, though, right? I mean, Markets have come a long way in a very short period of time. I mean, before this recent last few days, the market was up, 25% over the past year. I mean, that's like, even under the best of circumstances, you would expect a correction. So there's no reason to get, overly panicked about this. Not at all. The economy is strong. It's fine. But, we have to come to the realization that there's 3.5% unemployment. If that's where we're headed, and I think we are, that's not sustainable long run. That's going to create problems and higher interest rates, and markets are going to have to adjust to that. We're not going to get 25% gains in stock prices forever. On average, historically, it's closer to 5. So that's what we should expect to see.
I thought we were going to get it forever. Why did you tell me that we're not now? All right. All right, Mark Zandi, always good seeing you, my friend. Thank you very, very much.